Let's break this down. The US debt has been growing at an alarming pace, reaching levels that make traditional methods like raising taxes, cutting spending, or issuing more bonds less effective. Investment. Interest payments alone are consuming a larger portion of the federal budget, limiting the government's ability to invest in growth or respond to emergencies. In such a scenario, alternative strategies are gaining attention. And among the most talked about ideas are Bitcoin and gold. Could these digital and physical assets really play a role in reducing national debt? It's an intriguing question. Bitcoin is decentralized, limited in supply, and often described as digital gold. Proponents argue that if the government could leverage Bitcoin holdings or encourage national reserves, it might hedge against inflation and increase purchasing power without printing more dollars. Gold, on the other hand, has been a store of value for thousands of years, offering stability when fiat currencies face devaluation. Both assets share a key appeal: scarcity. Unlike dollars, which can be printed, their supply is finite, which theoretically preserves wealth and can be used strategically to pay down obligations. However, this is where the conversation gets complicated. Bitcoin's price swings can be extreme. Double-digit daily changes are not unusual, and gold, while more stable, does not offer the kind of liquidity that US debt obligations require on a daily basis. Relying on these assets as a backbone for debt reduction would require careful timing, market insight, and frankly, some luck. Investment. Any significant misstep could result in the government losing more than it gains. Additionally, integrating these assets into the national treasury would demand unprecedented regulatory frameworks and international coordination. Investment, as both markets operate globally and are influenced by factors far beyond domestic control. Another consideration is perception. Financial markets, investors, and the public tend to view national debt management through a conservative lens. A sudden pivot to Bitcoin or gold could trigger uncertainty, affect interest rates, and even destabilize confidence in the dollar. The government's credibility in managing money is critical, and unconventional strategies, no matter how theoretically sound, carry real risks in the court of public and investor opinion. So does this plan work? In theory, yes. Scarce assets like Bitcoin and gold could be leveraged to reduce exposure to inflation and strengthen the nation's balance sheet. In practice, the execution is fraught with volatility, regulatory challenges, and public perception risk. This is not a guaranteed solution. It's a strategic experiment at a national scale, one that could either mark a bold step toward innovation in fiscal policy or highlight the dangers of relying on markets outside conventional control. The takeaway is clear: creative solutions like these are being explored because the problem is serious, but no single strategy, no matter how revolutionary, replaces careful planning, fiscal discipline, and prudent economic management. The U.S. debt has reached unprecedented levels, surpassing $33 trillion, and it continues to climb. For decades, the government has relied on traditional methods to manage this debt: raising taxes, cutting spending, and issuing bonds. Each of these approaches has its limits. Raising taxes, for instance, can slow economic growth because it reduces disposable income for consumers and capital for businesses. Cutting spending, while theoretically sound, often faces political gridlock and resistance from various interest groups that rely on government programs. Issuing more bonds, which essentially means borrowing from investors, only works if there is consistent demand, but that demand can waver depending on interest rates, inflation, and investor confidence. Interest payments alone are consuming a growing portion of the federal budget, reaching hundreds of billions of dollars annually. This means that more of the government's resources are being diverted to servicing debt rather than investing in infrastructure, education, healthcare, or economic growth initiatives. This debt spiral creates a situation where the government is caught in a cycle. It needs to borrow more to pay interest on existing debt, which in turn increases the debt burden further. Economists warn that prolonged reliance on these traditional mechanisms increases vulnerability to economic shocks. For example, any sudden increase in interest rates can drastically raise debt servicing costs, investment, forcing the government to either borrow even more or make painful cuts elsewhere. Compounding the issue is inflation, which erodes the real value of government revenue, but simultaneously increases the nominal cost of servicing debt. This mismatch between revenue and obligations creates a fragile fiscal position. Traditional debt management strategies also fail to address the structural aspects of the deficit. Long-term programs such as Social Security, Medicare, investment, and defense spending grow predictably over time, creating obligations that are difficult to reduce without serious reform. Meanwhile, revenue streams are subject to economic cycles, meaning that during recessions, tax income falls even as obligations remain the same or grow. This imbalance makes purely conventional strategies insufficient. The government has experimented with various tools over the years, such as quantitative easing and temporary stimulus programs, but these often address symptoms rather than the root problem. Ultimately, the conventional approach struggles to offer both stability and growth. It works in the short term, but the long-term trajectory of debt continues upward, signaling a need for alternative solutions. This is why policymakers and economists are increasingly exploring unconventional methods to strengthen fiscal health. Investment. One area of interest is leveraging scarce assets like gold and Bitcoin, which operate outside the traditional financial system. These assets offer an appeal that traditional strategies lack: a finite supply and resistance to inflationary pressures. While they are not without risks, the consideration of such assets highlights the limits of conventional debt management. When traditional methods plateau in effectiveness, investment, exploring new avenues becomes not only attractive but necessary for maintaining economic stability and preserving the government's ability to fund its obligations without undermining public confidence or long-term growth. Investment. Bitcoin and gold have emerged as two of the most talked about alternative assets in the financial world, and their potential role in national debt management is increasingly debated. Both assets share one critical feature: scarcity. Bitcoin, with its hard cap of 21 million coins, is immune to arbitrary increases in supply, unlike fiat currency, which can be printed at will. This scarcity creates an inherent store of value, especially in times of inflation or currency devaluation. Governments that hold reserves in Bitcoin could, in theory, use its appreciation to offset some of the pressures of rising debt. The decentralized nature of Bitcoin adds another layer of appeal. It is not controlled by any single institution or country, which theoretically protects its value from domestic monetary mismanagement. This decentralization allows it to act as a hedge against fiscal policies that might otherwise devalue national currency. Gold, on the other hand, has a centuries-long history as a safe haven asset. Its value is recognized globally. Investment. It is inherently limited in supply due to the physical constraints of mining and extraction. Central banks around the world have long used gold reserves to stabilize their currencies and as a hedge against economic crisis. By leveraging gold, a government could potentially shore up confidence in its financial position while maintaining a tangible asset that can be liquidated if needed. Both Bitcoin and gold also serve as alternative stores of value that do not rely on traditional debt instruments or interest-bearing securities. In a scenario where investors become wary of U.S. Treasury bonds due to mounting debt levels, having reserves in Bitcoin or gold could provide flexibility and confidence in the government's ability to meet obligations. Some analysts suggest that strategic purchases of these assets could act as a form of capital appreciation and effectively turning part of the national treasury into an investment vehicle. There is also the argument that integrating Bitcoin and gold into national reserves could diversify risk. By not relying solely on fiat currency investment, the government spreads exposure across different types of assets, which could mitigate the impact of inflation or currency weakness. However, this approach requires careful planning. Timing is critical, particularly with Bitcoin, and which is known for extreme volatility. Gold tends to be more stable, but still fluctuates based on global supply-demand dynamics, geopolitical tensions, and economic cycles. Using these assets strategically involves constant monitoring of market conditions, understanding global trends, and making decisions that balance risk and reward. While neither Bitcoin nor gold is a panacea, their inclusion in national financial strategy represents a forward-thinking approach to debt management. They offer alternatives to traditional fiscal tools and provide opportunities to strengthen reserves, hedge against inflation, and potentially reduce reliance on borrowing. As traditional methods reach their limits, considering these unconventional options is becoming a serious discussion point among policymakers and financial experts. The idea is not to replace conventional mechanisms entirely, but to complement them with assets that offer scarcity, global recognition, and potential appreciation, creating a broader, more resilient approach to managing national debt pressures. While Bitcoin and gold offer intriguing possibilities for managing national debt, there are significant risks and limitations that cannot be ignored. Starting with Bitcoin, its extreme volatility is a major concern. In a single year, the price of Bitcoin can swing by hundreds of %, driven by market sentiment, regulatory announcements, or macroeconomic developments. For a government attempting to stabilize debt using such an asset, investment. These price swings translate into uncertainty. If a large portion of reserves is held in Bitcoin and the market suddenly drops, the government could face losses that outweigh any potential gains, creating a situation even more precarious than relying solely on traditional methods. Additionally, Bitcoin's relatively short history as an asset complicates its use at a national level. While it has shown impressive growth and resilience in certain periods, it has also experienced dramatic crashes. Unlike gold, which has been a recognized store of value for thousands of years, Bitcoin lacks a long-term track record of stability under extreme economic stress. Regulatory challenges also loom large. Governments worldwide are still figuring out how to regulate cryptocurrencies, including issues around taxation, reporting, And legal status. Introducing Bitcoin into national reserves would require a robust framework to ensure security, compliance, and risk management. Cybersecurity risks are another major concern. Unlike physical gold, Bitcoin exists entirely in digital form, making it vulnerable to hacking, fraud, or mismanagement. Protecting large national holdings would demand unprecedented security measures, and any breach could result in catastrophic financial loss. Gold, while more stable than Bitcoin, also carries limitations. Physical gold requires storage, security, and insurance, which involve ongoing costs and logistical challenges. Its value, although relatively steady, is not immune to global economic forces. Geopolitical tensions, shifts in supply-demand dynamics, and changes in investor sentiment can all affect its price, sometimes sharply. Liquidity is another consideration. National governments have enormous debt obligations that require immediate liquidity to service payments, interest, and operational needs. Gold is not as liquid as cash or treasury securities, and converting large quantities quickly without affecting the market price can be challenging. Using either asset also introduces the question of public perception and investor confidence. Financial markets are heavily influenced by sentiment, and unconventional strategies like leveraging Bitcoin could trigger uncertainty. Investors may worry about the government's ability to manage volatility, while taxpayers may question the wisdom of holding highly speculative assets instead of more traditional reserves. Timing and strategy become crucial. Accumulating or liquidating Bitcoin or gold at the wrong moment could magnify losses instead of reducing debt pressures. This requires sophisticated financial planning, real-time market monitoring, and an understanding of global economic trends, all of which add complexity to implementation. While the theoretical appeal of these assets is clear, the practical challenges are equally significant. High volatility, regulatory uncertainty, cybersecurity risks, storage and liquidity issues, and the potential impact on public confidence all create formidable obstacles. Any government considering such a strategy must weigh these risks carefully and develop a comprehensive plan that mitigates downsides while maximizing potential benefits. The promise of Bitcoin and gold as tools for national debt reduction exists, but it is accompanied by serious limitations that demand caution, expertise, and precise execution to avoid exacerbating the financial challenges they are meant to address. The broader economic implications of relying on Bitcoin and gold to manage U.S. debt are complex and multifaceted, affecting not only fiscal policy but also investor confidence, currency stability, and long-term growth prospects. Investment. If the government were to adopt these assets as part of its debt strategy, it would signal a major departure from conventional monetary policy, sending ripples through global financial markets. Investors closely monitor government actions, investment, and a move toward alternative assets could be interpreted in multiple ways. On one hand, it might be seen as an innovative approach to hedging against inflation and strengthening national reserves. On the other hand, it could raise concerns about the government's reliance on non-traditional, potentially volatile assets, creating uncertainty about the stability of the U.S. dollar. Currency markets are particularly sensitive to shifts in perceived fiscal prudence. If confidence in the dollar wavers, exchange rates could fluctuate, impacting imports, exports, and international investment. The dollar's status as the world's primary reserve currency relies heavily on global trust in the U.S. government's ability to manage its finances responsibly. Introducing Bitcoin and gold into the mix could complicate this perception. Investment. Beyond currency effects, the strategy could influence domestic financial markets. Treasuries, traditionally considered the safest investment, might face reduced demand if investors question the government's approach to debt management. Higher borrowing costs could follow, creating a paradox where an attempt to reduce debt pressure inadvertently increases it. On the other hand, a carefully managed integration of scarce assets could diversify national reserves, providing a hedge against inflation and a potential buffer during economic downturns. This diversification may also encourage innovation in financial instruments, sparking new avenues for investment and potentially strengthening overall market resilience. There are also implications for monetary policy. Central banks rely on predictable reserves to manage interest rates, lending, and liquidity. Adding Bitcoin, with its inherent volatility, introduces uncertainty into traditional monetary tools, forcing policymakers to adapt strategies to maintain stability. Gold, while more predictable, does not offer the same liquidity as cash or bonds, requiring adjustments in how reserves are allocated and utilized. Social and political considerations cannot be ignored. Public perception of the government holding cryptocurrencies or large gold reserves may vary. Supporters could view it as a forward-thinking, proactive strategy to secure the nation's financial future. Critics might argue that it exposes taxpayers to unnecessary risk, potentially eroding trust in fiscal governance. Internationally, other nations will watch closely. U.S. actions often set precedents, and a shift toward alternative assets could influence global reserve strategies, investment flows, and even bilateral economic relations. This creates both opportunities for leadership in financial innovation and risks of geopolitical tension if perceived as destabilizing. Ultimately, the broader economic implications hinge on execution. Proper planning, clear communication, and measured implementation are essential. A misstep could amplify uncertainty, impact markets, and undermine confidence in both the dollar and government debt management. Conversely, if executed wisely, integrating Bitcoin and gold could provide a complementary tool alongside traditional strategies, offering diversification, inflation hedging, and an innovative approach to long-standing fiscal challenges. The potential exists to strengthen economic stability, but the margin for error is narrow, and the stakes are exceptionally high.